generally prices are going to bounce. So a good trade at this point, and especially the VIX, would also increase dramatically. Now, what happens when the VIX increases dramatically? Well, the prices of options go up as well. In fact, they're probably at pretty high levels in this area of prices right here. It's a good time to sell vertical puts, to capture the premium on vertical puts, because generally whenever you have a sell-off like that, you're also going to get a snapback, and that's exactly what happened. Now, if I was going to add to my positions, what I would do is maybe when it came back up into this resistance level here, it would be a good time to sell some calls, vertical call spreads, selling vertical call spreads. So measuring the support and resistance points is an important technical tool in order to determine when you should be doing certain type of trading activities. That's just one way I use support and resistance points. Let's talk about cycles for a second. Why do prices rise and then fall, rise and then fall, rise and then fall? I mean, why do they do that in the first place? Well, of course, the smart aleck answer is that there's more buyers than sellers when they're going up, and there's more sellers than buyers when they're going down. And there is some truth in that. But there's also, it has to do with not just economic cycles, but also cycles in cyclical cycles in sectors. That was very difficult to say. Cyclical cycles in sectors. Say that 10 times really fast. Anyway, what happens generally is that the large mutual funds and other professionals that manage money on a professional basis for investors and 401k plans and mutual funds and all of the funds that invest on behalf of individual investors, they have to go out and buy stocks because money is inflowing from investors into their funds, and they have to go out and buy stocks. Generally what happens is there is a sector in which the majority of the mutual funds are going to be putting their money. Now they have to put in money into thousands of companies because they have so much money that if they were just to start buying a single stock, that stock would go into the stratosphere. You know, they could, if all of the mutual funds decided one day to go out and buy shares of, let's say, Starbucks. Well, Starbucks would go from their current level of about $17.50 to probably $350 within a couple of weeks. There would be so much buying of Starbucks stock that it would just have absolutely no price resistance to the upside. And the mutual funds know that if they did that, they would never be able to get out of those positions. There's just no way. There'd be no buyers left that they could sell to. You know, once prices got to a certain level, they'd be the only people holding the bag, and you know, prices would dramatically fall against them. So instead of that, they spread and they buy sectors. They buy industries. So for example, recently the big run up over the last 9 months or so has been the oil stocks. You know, oil, the price of oil, a barrel of oil has dramatically increased in price from about $70 last August to currently as high as $135 a barrel. Well, along with that, a number of different stocks have, in fact, you know, gone up in price, and they are all in the oil industry. Here's one, RIG. Hess. Let's just take a look at the last 9 months because that was the biggest run-up. Oxy. National Oil Well. Now this one, it looks like it's actually gone quite a bit sideways, but it had a dramatic run before that, actually during 2007. And what else have we got? CNQ. And you know what? On a weekly basis, these even look more dramatic. Devon. And let's see who else we got here. That's pretty much it. The big stocks have had the biggest run-ups. I mean, these stocks are just absolutely incredible. I mean, you can even go back, a couple of years, and you can see what a price run this has had. Absolutely incredible. So what always happens after an exuberance of price like this? Let's say mutual funds started getting involved in this because they're far-seeing, they have tremendous research, and they knew the price of oil was eventually going to go up. Well, if they took they started buying their positions back here at $40, $50, $60, $70 level, and now they find themselves with profits at the $155 level. And they don't buy a single stock, they buy an industry. So in other words, they've taken positions not only in RIG, but in Hess, Noble Energy, Oxy Petroleum, National Oil Well, Canadian Natural Resources, Devon Energy, Halliburton, and a lot of the other, I'm sorry, not Halliburton, that's on another list. All of the stocks, all of the energy stocks, all of the oil stocks, they're not going to take position on just one. They're going to buy the whole industry. They're going to buy the whole sector. And now they're at a place now where they have significant profits in these stocks. The question is, how do they get out of them? Well, for a lot of mutual funds and a lot of other companies that take investors' money and invest it for them, the answer is simply to go out and sell it. Just sell it. But they can't sell it all in one day, otherwise they'd have a tremendous drop in price. Very similar to the drop in price that we had right here. In this one particular stock, you can see that prices went from about 144 all the way down to 120 in a single month. Let's kind of close in on that a little bit. You can see the dramatic rise in price here. But during the beginning of February, in January and February of 2008, we had a tremendous sell-off in prices here. And pretty much the majority of mutual funds and those who manage 401ks and other investment funds, when they want to get out of a stock, they will get out of a stock, and they will probably generally do it over the period of several months because they have large positions. And those sales turn up on the charts as these large sell-offs here. They sold off, they got up to another price level where they sold off. Who's buying down at these price levels anyway? I mean, if the large mutual funds are starting to sell out of their positions, who's buying here? Well, a lot of us. A lot of individual investors who have seen this tremendous trend and are taught to buy on the dips. Yeah, it's worked pretty well so far. I mean, if you bought all of these dips, you'd be making money, right? And it does. The trends do last for a lot longer than you might think. And that is a good way to make money. In general, however, when you see large price drops with correspondingly large volume, that is a sign that institutional investors are selling the stock. And that's generally not a good sign for the future of that stock. So, over the period of this time here, you saw a couple of very large sell-offs with some large volume on the downside.